what a day yesterday Tattooed Chef had. It had an amazing day on the stock market, and there was a lot of debates on YouTube about the potential of Tattooed Chef as well. So we've got a lot to cover today, but the stock had a very good day yesterday, up 10%, and I've even got some footage of me looking at the stock chart yesterday celebrating the move. But all jokes aside, we're going to get stuck into some Tattooed Chef, talk about the move, and also talk about some of the videos that were put out yesterday about Tattooed Chef. So first of all, just talk about the stock move. Obviously, it's a great move up yesterday after an earnings that was, I think, a bit of an overreaction. I don't believe earnings should have really moved the stock down as much as it did do. Sure, the earnings could have been slightly stronger, but for the stock to go down that much, I think was an overreaction. And the amount of people that I saw lose faith of the company because of that one earnings was crazy. You know, the thing is, as a long-term investment, to be judging a long-term investment over one quarter is scary. Sure, you know, I made a video myself saying it could have been slightly better and it should have been slightly better, but to me, to change my opinion on a long-term investment off one quarter would be absolutely crazy. So it's good to see this share price starting to move back into the right direction. Obviously, there was long-term investment. It's important not to get too excited with that short-term movement. Obviously, the time to celebrate is when it's sold in a couple of years' time, when hopefully I've made some good money on it. But overall, yeah, some good stuff going on with Tattooed Chef. Now, two little things, when we have a jump like this, I think everyone goes, so why has it gone up? Why has it gone up? And I think sometimes that's what happens in the stock market. Sometimes the stock market is so unpredictable, especially in the short term. Things can go up, things can go down. And yesterday was just one of those days where it went up quite a bit. Now, there's two reasons potentially why it could have gone up quite a bit yesterday. First of all, there's a lot of institutions that look like they're buying the stock. So when big money comes in, obviously that's also going to help the share price. A lot of institutions buying into Tattooed Chef. And also there's a lot of short interest going on Tattooed Chef. So the combination of maybe a lot of people coming in to buy the stock, but also then a lot of people are shorting the stock, which has gone up quite a bit as this year's gone on. Obviously, then you might have a few shorts having to cover some positions as well. So the combination of a few institutions buying and the covered calls or covered the shorts could be the combination of why we had a pretty good day yesterday. But as well as Tattooed Chef doing very well on the share price side of it, there was a little bit of drama unfolding on the YouTube side of it. And I'm pretty sure that most of you guys probably will know what I'm kind of on about. And if you don't know what happened yesterday, there was also a YouTube channel that focuses on value stocks that looked into Tattooed Chef and basically said a few things about Tattooed Chef that I did not agree with. And in fact, I feel like some of the points they made on the video were very unfair. And as it is one of my investments, I do want to kind of come out and address some of these points on this video and just kind of stick up for the investment for a little bit. Now, fair enough, I'm open that if, you know, the stock market is built on opinions. You know, I'm not bothered if, you know, if I'm bullish on a company and someone's bearish on a company and I put my bull case forward and they put their bear case forward, and it's, you know, fair enough, there's a strong argument there. Fair enough, we'll see who's right in the next kind of couple of years. Same as if someone's bullish on a company and I put a bearish argument out. You know, there's plenty of videos or stocks that I've looked into on the YouTube channel and I've gone, for me, yeah, it's not a buy. You know, I've done that before and someone else might be very bullish on it. And you know, if you have a disagreement, that's fine. You know, the stock market is all about opinions. But there's a point of view where it comes to where it's not even a bear case against the stock. It's just making a lot of information up to suit your agenda against the company and not giving it a fair look into. Then I feel that's a very unfair look into a company. And especially when you're at a point of view where the channel that did this has a big audience. In fact, I think they are over 70k subscribers, and I think, you know, 7 times what the subscriber base that I have. When you have that amount of audience, if you're putting information out there that I think is not a fair opinion of the company, then I think that needs to get addressed. You know, I don't mind someone coming out and saying, oh, I don't like Tattooed Chef because their products, if you look at the reviews, they're awful reviews. If you look at management team have a horrible history of executing on expansion. If you were to look at the amount of stores they have, the stores are decreasing or slowing down or flatlining. If you were to kind of put a bull case point of view from that point of view, and you had evidence to back that, I'd be like, fair enough, you know, you made some good points, we'll see who's right in a few years' time. But the information that was put out there, I felt was like to suit an agenda against a couple of these stocks, particularly just because they are now gaining a bit of attraction as well from a lot of retail investors. So Yeah, I think the big thing that I've always liked about the channel that did this is they've always kind of come from a point of view is like, look, growth is going to trade at a premium. Everyone knows that if you have a company that is growing at 4% revenue, or you have a company that's growing at 60% revenue, which company is going to be the higher valued company? Is going to be the company that's trading at 60% revenue growth, because you have more growth, people are going to be more attracted to growth. Everyone knows that, and what the channel that did this video was a big believer on, don't overpay for growth. And I especially think right now, potentially a year ago, especially I think the peak time was like February, and I think at February we're getting to the point of view where there was just so much speculation on companies that had profit that was just awful, that was they're losing money, the revenue was doing nothing, or they had no revenue, and there was companies that were getting hyped up from that point of view, the people paying 60 times sales for a company that had no product and no revenue. And from that point of view of like, a bit of a reality check, what's the point? There's no point paying for speculation or paying crazy amounts of growth, and I do agree with that. But there's also a point of view where you go, growth is a premium, and at some point you've got to realize, okay, if I do want to have a growth play, if I see a company which I think is going to be a massive company in the next few years, and you see the potential, that you kind of go, okay, I am paying up more than what I would for a value play, but the growth potential in this one could be huge. And I think when you if you give that a fair point of view, then you might see a good investment. The problem is that what I saw yesterday is the review on Tattooed Chef was a channel that focuses on value stocks and still uses value stock metrics to then go value a growth stock using value metrics. You are not going to find a single growth stock using value stock metrics. It's not going to happen. Maybe there might be the odd one or two. Maybe that was a bit of an overreaction what I just said there. But you might find the one or two stocks that you might find. But there's no way you cannot value a value stock for a growth stock, because you are paying up for a value stock. You're looking at companies that will be growing at 3-4% revenue growth, growing profit at 3-4% revenue growth, not looking at the potential that they do have if things work out for them. And in fact, not even if things work out for them, if they are a proven growth stock and you have the clear path of how it's going to unfold in the next few years. If you see a company that has been very successful, a growth stock that has been very successful at their expansion, and you kind of look into that company and you go, okay, I've seen how well they've executed so far, and looking at what is currently in the pipeline and what they're executing now, and you see the deals they're landing right now, and them deals are going to come into effect further down the line, and the potential expansion from them, and looking at the potential other income streams they add into their company. That's how you kind of manage growth stocks. And that's the big thing. You've got to really look at growth stocks and look at their expectations, where they're going to be. You can't, with the stock market and companies, you can't value companies at where they are right now, because everyone knows where they're at right now. You've got to look at the companies, every single company, whether it's a value stock, whether it's a growth stock, and you've got to look at them companies and go, okay, I've got this company here. If it does, even value stocks, you're looking at where they're going in the future. You don't invest into a company because of what it's done previously. You're going to take that into consideration, but then at value stocks, you're going to go, okay, so historically, let's say they grow at 3-4% revenue rate, carry on this, that's where it's going to be. It's exactly the same with growth stocks. And you can say, well, growth stocks is like a little bit of speculation and a bit more like the unknown there. And that is the point of growth stocks. They do have that little bit more risk than, say, a value play. But the thing is as well, you can't trade them with the same sort of valuations of value stocks. And it's crazy. There's no point being looking into value stocks and then valuing growth stocks and value stocks, because every single growth stock's is going to come up as not a buy. It's just stupid. If you are going to value growth stocks, you have to trade them at a little bit more of a premium than a value stock. And I just feel like being a value stock channel going on to growth stock, it's just pointless. It's like me, I don't invest in crypto, and it's like all of a sudden one day me starting to talk about crypto, I'll probably say that every single crypto is not a buy, but that's just because I'm not interested in it. And because I'm not interested in it, I don't talk about it. That's the thing, I stay in my lane. I at no point when I go to buy Airtel Africa, which is a solid dividend play, do I use the same sort of metrics when I go into Greg's, which is a value play. At no point when I'm looking into growth stocks, I'm going to value Tattooed Chef the same as what I valued Airtel Africa. I'm not going to value it the same as Greg's. It's just bonkers to do it. In fact, it's stupid. You might as well value, if you're going to do that, stick to value stocks. There's no point going into growth stocks. I just thought that was stupid. Now, the next thing is YouTube hype. So there was a big statement saying, oh, Tattooed Chef is just a hype stock. It's just built up on hype. Now, I have to agree, and I've said this before, there is, especially over the last 12 months, there's been an increase of hype on YouTube. There has been, what I said earlier, there has been stocks that have 0% revenue, no revenue at all. Maybe they have a prototype. Maybe they're selling 6 of them prototypes. The profit is just horrible. The balance sheet is just horrible. And especially over 12 months, there's been a lot of YouTube hype building up them stocks and going, oh, but maybe they'll land this contract, or when this happens, this could happen. And there's been a lot of speculation stocks that are being hyped up to be the next big thing on YouTube. And I agree there's a lot of YouTube hype on there. And if I see YouTube hype potentially, I'm not afraid to call YouTube hype out. That you guys were probably on the channel that you might know there was a certain Irish YouTuber only 6 months ago that was hyping up 2 companies, one that was going to land a massive contract. They didn't land it, and then the share price has gone down 75% since then, and the CEO, a lot of the management team have sold off massive amounts of their shares, and to this day they're still only producing 6 vehicles, I believe it is. And another stock was a company that, same again, this YouTube channel was doing interviews with the CEO, had no proven history of producing anything, no revenue, had a prototype. Turned out the CEO then had to leave. They then had the SEC investigate them. They then also revealed they didn't have enough money to actually build the models, and then that stock's fallen down like 75% since then. And when I see people hyping up just pure spec for their own agenda, then I will call that out. And I think when you see them sort of things, it's wrong, and you realise that then people are making content for their personal gain and their personal finance gain, and I think that's totally wrong. And if you see that, then you call it out. But to then put a Tattooed Chef in that same sort of category was just massively wrong from my point of view. There's a difference between having hype on a company and then actually producing facts and going, you can get excited about a company. You can invest into a company and get excited about it. If you see a company doing something that you really like, you can get excited about it. If you're saying facts, if I went, Tattooed Chef, they've just landed a massive deal with Albertsons, Whole Foods, Kroger, expanding to the UK, just bought the new foods in Mexico. They've just gone from 4,000 stores to 12,000 stores this year. Their average SKUs in every store has gone from 4 SKUs to 7 SKUs in every store. There's a difference between there's overhyping a stock, and there's a difference between being excited about a stock. I'm excited about Tattooed Chef. I'm not hyping up Tattooed Chef. I am excited because I have just named you facts of what the company is producing, and when the company keeps producing them sort of improvements in the company, that's going to lead to very good revenue growth in the company. And then further down the line, I believe a lot of that revenue growth will go to the bottom line, and we'll also see a lot of profit growth as well. So for me, I don't like this kind of saying, oh, we are the only YouTube channel out here that you should trust. Everyone else out there is hyping up stocks. I agree, there's a few people out there, but to say everyone else out there is wrong and we're right, I don't like that sort of attitude, because I get excited about my investments, and that's why I invest into a lot of them. I invest into a lot of the companies because I'm really excited where this company's going, and I'm excited where the company's future is, and I think the share price will be going in the right direction with that company. There's a difference between naming facts and getting excited about it, and then just overhyping things. And I feel like just to kind of go we're right, you're wrong is totally wrong, because I feel out there's a lot of really good content creators out there that have done massive amounts of research into companies, got excited about it, and also, you know, they've kind of gone, oh, this company's really good, and then they're proven to be correct. And I think to go everyone's wrong and we're right, I don't like that sort of attitude. So the next point as well was about the share price, and it's going, oh, it's a typical hype stock. This stock overhyped, went up to, I can't even remember what 52 highs on Tattoo Chef is, I think it's like $28, went to like $28, and then it's fallen back down and it's fallen off a cliff. So if you look at the stock chart of Tattoo Chef, you can argue, okay, yeah, it went up to $28 and then it has pulled back a little bit, but a lot of the, if you know the small market caps, if you know like the Russell 2000, if you look at them sort of companies, you know a lot of the small market caps, it's been a pretty bad kind of couple of months for them. A lot of small market caps are flat or maybe down a little bit. But then to take that into the point of view going, oh look, it's a typical hype stock, it's fallen off a cliff. Okay, but we could work that the other way, and if you actually go on the 52 close, this stock's nearly up over 100% still this year. So you can take a little bit of a fact and then do that you can take that to suit your agenda, or we can actually take an actual whole stock chart here and go, actually it's still up 100% over the last year. And that's one thing I didn't like, is taking little things to kind of suit your point of view, but you can argue it both ways. Personally for me, you know, even I'm not really bothered where the stock price is right now, because I'm not investing for where the stock price is right now. I'm investing where the stock price is going to be in the next 2 to 5 years. And that's what I'm kind of looking at. And the fact that, okay, maybe if it's down a little bit, for me, that's, you know, what you basically, the basic thing of investing is if you believe in a company and the company starts going down a little bit in value, you probably want to be buying it. And I can't believe if I ever meet another investor, you're not going to be, if you kind of think that if you want to be a successful investor, that is part of the game that you've got to learn, is that if stocks start going down, more than likely, if you believe in the company, you should be buying that dip, because you're going to make more money in the long term if you can get your average lower. So I didn't like how the share price was used to kind of suit an agenda as well. Next up was the outstanding shares. So the outstanding shares was used massively in the video against Tattoo Chef. So they kind of said that I can't remember exactly the amount that it is right now. I think it's just around about 30% share dilution. And kind of going, oh look, if you invest in this sort of company, you're going to be invested into a company where they just dilute you and you have less ownership in the company. That is true. That is a fair point. But once again, if you take that out of context, you can take that out of context and go, look, that's a bad company because the outstanding shares is increasing. Okay? But if we take the outstanding shares in context, okay, the outstanding shares was always part of the SPAC deal. After the SPAC deal, the warrants came out, the warrants diluted the shareholders, and then that raised cash to go into the balance sheet. Then you have a balance sheet that's even stronger. Now, if you kind of know Tattoo Chef, you will know that they do not burn through a lot of cash. One thing that was, we're going to talk about this in a second, and they said, oh look, they're burning through cash, but they just went off the last quarter that had a one-off payment. Now, if you don't do any DD into the company, you don't realise that last quarter had a one-off payment. If you look previously over every quarter and historical of the company, it doesn't burn through that much money. So if you look at the outstanding shares, you would have realised that was a one-time dilution of shares to raise capital, and that has been known all along. That raise of capital then goes onto the balance sheet, and people say, oh, you know, they say it's company. This, I think the point of view was, it's a point of view that the company goes, oh, our shares are overvalued, we're going to dilute everyone because our shareholders are stupid. The biggest shareholder in Tattoo Chef is Sam Galletti, the CEO and founder. So he is getting the most share dilution out of everyone as well. But anyway, back to the point of that is that shares diluted were to raise cash. Now, I agree, it's not great, and you don't want to be in a company that dilute shareholders all the time, but there's a point of view where you've got to realise, okay, you look at Tattoo Chef and they've just gone from being in Walmart to having free SKUs in Target, and that's pretty much everything they've had. And then the branded products only existed 2 years, but now they've grown revenue at 67%, I believe it was last year, 63% potentially this year. And then you look at thinking, okay, in that time as well, the SKUs in Target have gone from like 3, I think is it 8 now, the fastest selling frozen food product ever in Target's history. You've got Walmart that's increasing the amount of SKUs. You've landed your Albertsons in there, Safeways in there, Whole Foods in there. I don't know if I said that one. Kroger in there. There's so many different partnerships they have now. And the thing is when you're expanding that fast, when they're raising cash here, They're raising cash to strengthen up that balance sheet. Now, they probably won't need to dilute shareholders again. Potentially the only thing they will ever dilute shareholders for is acquisitions. But when they raise that cash, you've got to kind of look at Tattoo Chef and go, what are they going to do in long term? You look at what they've done with that cash since they raised it from the warrants. They went out and bought new foods in Mexico. Now, if you don't do DD into a company, then you don't realise that, and you just look at them numbers and go, oh, it's terrible, isn't it? But if you look into the company, then you realise, oh, they bought new foods in Mexico. So they bought new foods in Mexico that could potentially add 200 million to the revenue. It's also going to help with 2 new facilities. They're going to double the amount of facilities they have, and they're doubling them 2 facilities in the company to help with demand, because they've just signed massive amounts of contracts with the biggest retailers out there. And to keep up that demand and to grow that fast, you need to expand. So from my point of view, yes, you can take outstanding shares as looking negative, but when you look past the point of what they're doing with it, they're doing it because they are growing revenue a huge amount, and because they've signed so many new deals with so many SKUs increasing every store, they need to keep up with the demand. Now, they could turn around and go, oh, you know what, let's not raise shares, let's not raise capital, let's not go buy new foods in Mexico. But then you're turning down the potential to get into the likes of Kroger, doubling the amount of products you have in Target. What happens then? Oh, your revenue then goes down a huge amount. What's the point? You know, at the moment, Tattoo Chef is a very hot product, and they are taking a lot of market share. They might as well right now take a lot of market share, and then when they've taken a lot of market share, that will translate into the bottom line. And from my point of view, is you just take that one thing out of context, it does look terrible, but when you then look into what is happening and what's going on with that it looks really positive. And then what happened here is the one-time share dilution, and like I said, they probably won't dilute shareholders unless they make an acquisition. But then you look at the outstanding shares, and it was that one off, and then all of a sudden, I think when they did the final sum to get a valuation of what Tattoo Chef will be, they did like share dilution of like 10, 20, 30% every year, and it was just absolutely nuts. And that just kind of, if you don't do your research, then you're going to put in stupid numbers, and that's what happened. Next up, profit. This is a little bit of a short one, but it basically went on to say, look, the company's losing this amount of money, but that was just the one-time payment on the recent quarter. If you look at Tattoo Chef historically, they've kind of pretty much been a little bit profitable, dropped out of profit by a little bit, and eventually that will come. The thing is with a company like this, is that you've got to appreciate, if you want to ramp up as the pace that Tattoo Chef is doing, you've got to put investments in. There's no way you can kind of go from 4,000 stores to 12,000 stores with no investment. And that's the thing. Every successful company that has ramped up previously has done that by putting a lot of investments in. And that's part of the game, especially on growth stocks. And this is what the thing, if you don't appreciate that on growth stocks, then just stick to value plays. And there's nothing wrong with sticking to value plays. There's some really good value stocks out there. But don't then put that kind of expectation onto growth stocks for sure. Next up is, as well, as a comment about not having to do DD. And potentially I'll agree. You know, you can certainly scan a couple of companies and look at previously what they've done, look at balance sheets, and kind of get a good idea of the company. But the thing is, if you're going to come out and attack a growth company without doing DD and then put a lot of false claims out, then it starts to show. And I think that was very narrow-minded. If I kind of want to do a video on YouTube, I put it on myself to kind of do, okay, I'll do a financial scan through it and see what I think, but as well, I'll just get some little information about, okay, what's the company doing, are they expanding, what's the business plan, what's the outlook, and get a lot more deeper look into the company. I feel like the lack of DD into the company kind of showed that if you just take some little numbers out of context, it can make an investment look a bad investment. And I think that was very narrow-minded, and I think that kind of showed in the video when you looked into it. And also the last one was the valuation. Once again, at the end, they kind of put through a calculator that they have to kind of get a valuation. A lot of the valuation through there was put through as a bit of a value play rather than a growth stock. And I agree that the valuation on Tattoo Chef, once you mature as a company, you can't trade it. If your growth slows down, then you won't trade as much of a premium. But there's a point of view where I run my numbers through Tattoo Chef and what I expect them to do and what valuation they will be, and it just felt like there was a lot of things in there, like the outstanding shares and diluting shareholders, 20-30% every year as well, and stuff like that. And I think as well, like trading at a P ratio of 20. Now, for me, Tattoo Chef, like I said, the valuation will drop as it gets to, more mature, as the revenue slows down, we have a lot more profit coming in. It won't trade as a rich valuation as what it potentially does do now. That will happen. It happens with every single company. But I think realistically, when we kind of get further down the line and we start talking to Tattooed Chef, and my always process is where it will be in like 2025, 2026, and then I think they'll be doing about $1 billion of revenue. We'll see what exactly the profit margin is. Could be somewhere between 5 to 10% there. But realistically, on the revenue growth side of it, this company was then valued to trade at like a 20p ratio. Now, if this company is growing at 3-4% revenue growth, 20p ratio potentially. But realistically, if you have a company, what Tattooed Chef could be, and it's putting in the numbers I expect it to do, this could easily be a P ratio of potentially trading to a 30 to 40 P ratio, because it's going to trade at a premium. And even it has the potential, if we are in a crazy bull market, it could even go higher than that. But for me, my whole basis of why I bought Tattooed Chef is because I looked and I thought, 5 years down the line, where do I see Tattooed Chef being? I see Tattooed Chef being a $30+ stock minimum, and I think it could go to being a $60 stock. And for me, then I look and think, okay, that's at least 100% upside, and potentially if they nail the numbers how they are nailing the numbers right now, because I feel like that's with sandbag guidance, there's even potential more return than that, because people don't realize is how quickly valuations catch up if numbers are beaten. One company in particular I always refer to is like Shopify. Shopify is always looks absolutely crazy on the valuation, but because they just keep growing and growing and growing and growing, the valuation is always like, oh, it's a rich valuation, but they always can keep up with it because of the growth they put in. Not saying Tattooed Chef will do anything like a Shopify, for example, but just that kind of, you've got to appreciate what they can do in the next few years, and I just feel like that didn't happen. So hopefully that was a useful video anyway on Tattooed Chef, and if you could hit the like button if you're new, subscribe, and I'll see you in the next video.